Hi, T.S. Hennessy. I'd like to welcome you to The Trouble with Technical Analysis today. There's a good bet there's someplace else you'd rather be, probably just about anywhere. But starting with some pleasantries, but this video is about why you're here. Really, that's what it's about. It's going to go into some things about The Trouble with Technical Analysis, or TA, today, but mainly it's about why you're here and not enjoying the fruits of your labor like most professionals. You're here because prices are moving like crazy, but you're getting stopped out way too much. There's no consistency, or when it goes well a few trades, then you get whacked, give a bunch back, and you can't reach your goals when the account takes hits that keep pulling it down. So yeah, you're here looking into whatever you can find that might help. But you need to know something. You actually need to know why you're here. There's two main things that are obviously what motivates you to be here. First, whatever you've tried and anything you've heard of doesn't consistently work. Another, you are determined to make this work because of your goals. These are kind of obvious secondary causes, but I'm talking the cause for the motivations behind why you're here. Maybe this sounds like a load of bull, but I'm going to promise you'll get an answer to that. This video has just one job. It's not fancy. This video is going to give the reason for the disgusting statistic, the 95% failure rate of traders, and why your endless search is not going to end unless you pay close attention. To me, well, I'm T.S. Hennessy, and I've made some discoveries. Besides that of not being a movie producer, but you should know who's saying this to you. And the point is, I've been there. I'm experienced in technical analysis, a trading system developer. I did publish the first new rule for Elliott Wave in 70 years. I run 2 forums and a chat. But I've busted accounts, wasted a lot of time on indicators, blah, 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 the whole thing. And I can appreciate that when you say you're up against it and stressed, you are. But if at any time during the video you get a little bored, then please just go find something else better to do. This is for those who really know there is something wrong and interested in finding out just what is the trouble with technical analysis today. So let's get on with it then. Prices go all over, without warning, without mercy at times. They can break the risk level in a heartbeat, and I'm happy for you that you're determined, but that statistic is there for a reason. It didn't just become an issue last year. You are depending on, your financial prospects are depending on, something for which you have no solution. And the reason is amazingly basic. We have global trade in stocks, currencies, commodities taking place in the blink of an eye using state-of-the-art 400-year-old technology. Your charts, your methods, your systems, and tools and indicators are nothing but computerized techniques that have not evolved for 400 years. A graph is a graph, whether the tablet is paper or not. It's just a tool. Is the tool doing its job? Not with a 95% industry-wide fail rate, it's not. Is it the fault of the tools? We know better than that because we have computers. We know it's garbage in and garbage out, whether paper or plastic. We know that charts are plots of price over time. Indicators plot lines, dots, arrows, etc. based on calculations based upon a price element, usually the closing price for a candle. So we have a price plot and we have an indicator plot, one for each increment of time. As you know, that's the composition of our trading platforms. That is also exactly what was done in the 17th century, just calculated and then drawn by hand. We can really only claim innovation if we progressed beyond that, and we haven't. You can automate and speed things up without changing what it is that you're doing. Placing trades and technical analysis are not the same thing. Okay, so candles and indicators. 400-year-old stuff on steroids. Technical analysis is data analysis, and data analysts use similar techniques of comparing data to obtain useful predictive information with typical professional success, or nobody would hire them. We have an objective of predicting price and getting in line with it. You're motivated to be here because of unpredictability and inconsistent results from technical analysis. And it looks like nothing has changed in forever, and continuing failure is TA's roadmap, and you're following the navigation. Is it in someone else's interest or yours to dig deeper into what we're doing? Yeah, yours. Technical analysis is data analysis, and there's no such thing out there as the AFRDA, the Association of Failure-Ridden Data Analysts. So why traders? It's your future financial prospects, and this isn't a game. Remember, I said the reason is basic, causative. Okay, no more pretty slides. We're going in. I have a promise to keep. This is a charting and trading platform I'm sure most are familiar with, MetaTrader 4. None of this will go beyond the 3rd grade, and yet it will immediately expose the cause of our industry's failure. A little time here for the groundwork. Please bear with the simplicity. There's a reason to handle the basics. Sorry, but there's no other way. The chart is prices displayed over time. This is a daily chart. Now this is a 1-hour chart. Only the open and close times are different, and that is handled by the platform. As soon as the clock changes from 1 hour to the next, the 1-hour candle will close, and all new incoming trades go into a new candle. That, of course, is how the time frames work. Daily time frames display all trades for 1 day in 1 candle. The time frame is an integral part of the ability to display a chart. And this chart display trade platform is often called a terminal. And there's another kind of terminal, a railroad terminal, where before automatic signals and switches, a chief engineer decided when one line of the terminal would close and all other train cars would be switched onto a different rail. This is a similar operation to how new candles form at the completion of the time allotted for a candle for that particular time frame. It is handled by the terminal. However, it is of utmost importance to know that you are the chief engineer, because you must decide which time frame you're going to use if you're going to use a chart. This will come into play a little bit later on in our discussion. So now let's look at the rest of the picture, and we'll catch up to our colleagues in the 1600s. We will add an indicator. I have added a 100-period simple moving average, MA, to this 30-minute chart. It averages the closing price element of the last 100 candles and plots the line. No drawing it by hand. Nice. Very nice. Well, what's the indicator for? It's whatever you want it to be for, but for the purpose of this video, it will represent any and all indicators, because as you'll see, no, you've already seen, they're all the same. But averages have many uses. The nature of an indicator is one thing, and how it is used is another. Not for lack of trying, here comes every trader's story of the search for something that works. Over 1 million approaches, but they all use the same thing, candle or bar. Here is a 1-hour chart with 4 moving averages, 25 through 200. The slowest, the 200, lags quite a bit away from prices, more so at times than others. The faster 25 hugs the prices more. So the MA position relative to price is one very common usage for MAs. Notice at the top right, the MAs are moving through price action rather than trailing. This is because prices have slowed. On the left side, prices were moving further in less time than they are on the top right. The slowing allowed the averages to catch up. Now that we've observed those basics, we look back again at the 30-minute with the 100 MA. You now observe that same situation here too. Prices are slow, then fast. You are somewhat aided in seeing this with the indicator, and of course that's their job. Our job is to make good use of their help. This is a basic analysis of price over time. I've used references to faster and slower, both for the relative price moves as well as the indicators. That probably went unnoticed because we think in those terms as we look at charts and indicators, but don't give it any real weight. We see faster and slower on the charts all the time, so what's to notice, right? Remember, one of the motivations for being here is unpredictability.